Internal Revenue Service IRS tax news. IRS joins leading nonprofit groups to highlight special charitable tax benefit available through December 31st. But first, an attempt at a joke/rant. I apologize in advance. The current administration is now proposing radical simplification to the tax code. The proposed new tax form having only 2 lines. Line 1, how much money did you make this year? Line 2, send it in. However, they would like to hold on to that SALT tax deduction, the itemized state and local tax deduction, to help those most in need, namely wealthy people in high cost of living states like California and New York. You'll recall that evil, greedy billionaire who lives in New York, a very high state and local tax areas administration, capped the state and local itemized tax deduction to $10,000. But the current, benevolent, highly competent, and impeccably trustworthy administration, always looking out for the little guy, will reinstate the SALT tax deduction as well as implement an inflation tax, which are both very regressive in nature, the burden of the tax falling on lower income individuals, a burden which will surely outpace a few $1,000 checks sent out by the government in the long run. Now let me be crystal clear here. I live in California and would benefit from the SALT tax deduction being put back in place, although I am not a billionaire. But I have never liked the idea of state and local taxes being deducted on the federal return. It's a subsidy to high cost of living states and clearly incentivizes states to act in ways that make them more and more dependent on the federal government. States, like individuals, become less well off when made more dependent, as seems to be clearly illustrated by the path California has taken in recent years. This is not a good incentive structure. Free stuff is never free, and when it is presented as such, it's generally a good sign that the best course of action is to say no thank you and move along your way. Special rule helps most people get a deduction of up to $300 per individual, $600 for couples for gifts to charity. National Council of Nonprofits and Independent Sector highlight how donations can help the nation's charitable community. IR 2021-247, December 13, 2021, Washington. The Internal Revenue Service joined today with several leading nonprofit groups to highlight a special tax provision that allows more people to deduct donations to qualifying charities on their 2021 federal income tax return. So prior to this, most of the time when we think about the itemized deductions, they're going to be the itemized deductions for charitable deductions, and therefore you would not be getting access to that deduction unless you were itemizing. But they've moved over this component or this portion of charitable deductions outside of the itemized range so that you could still get a benefit from it. In order to do that, of course, you would need to, and the clock is ticking, make the donation before the end of the year. So the Independent Sector and National Council of Nonprofits joined with the IRS to highlight this pandemic-related provision where married couples filing jointly can deduct up to $600 in cash donations and individual taxpayers can deduct up to $300 in donations. Obviously, if you're a tax professional as well, you might want to, be given your last-minute advice here. This might be some last-minute advice and so on that you could give before the year is closing out here. So under the temporary law, taxpayers don't need to itemize deductions on their tax returns to take advantage of this, which creates tax-favorable donation options not normally available to about 90% of tax filers. So in other words, the itemized deductions, you'll recall, was in an attempt to simplify the tax code. They basically increased the amount of the standard deduction, so more people would just basically take the standard deduction. You wouldn't have as much of the itemized deductions, and that means some of the favorite things that basically got put into the itemized deduction area then become less impactful as well. So that means one of them being the charitable deduction as a component of the itemized deductions is less accessible to most people, given the fact that it's an itemized deduction, and the whole idea was to phase out, in essence, all the kind of itemized deductions because most people take the standard deduction. So what you will probably see then is either a reverse of that happening, so they make the itemized deductions more relevant to more people, and or some of these deductions leaking out into other areas of the code, like the charitable deduction, which is now kind of in another area on the tax return. So ordinarily, people who choose to take the standard deduction cannot claim deduction for their charitable contributions, but the special provision permits them to claim a limited deduction on their 2021 federal income tax return for cash contributions made to qualifying charitable organization by year's end, December 31st, 2021. At a time when many charitable groups are struggling during the pandemic, the IRS highlights the new provision and urges people to make sure they donate to a qualifying charity. The Special Tax Exempt Organization Search Tool, there's a link to that here on irs.gov, can help people make sure they donate to a qualified charity. Now note that as there's these incentives going out and there's money like flowing out from the government to deal with pandemic related items, oftentimes through the tax code, then you're going to have these fraudulent types of things happening as well, these fake kind of charities that might be trying to pick up money too. So you want to make sure that when you give money to charity, you would like it to go to the thing that you're giving the charity for. That's the whole point, right? Otherwise, you could just let the government have it, but then it's going to be very inefficient in terms of where the money's actually going to be helping people. It would be much more efficient if you went through and chose a charity that it does what it does in an efficient way. And one tool to do that is to see if they are set up as an organized charity, as an actual charitable type of organization. So you could check that out, and then you'd probably want to do some further digging to see what the money is going to. But that's not the only thing you want to look at. You want to say how good are they at getting the money going to where it's going to be going. And to be good at that, you've got to reduce the bloat, which is more likely to happen in nonprofit and government organizations because you don't have the market pressure forcing them to be more lean and mean. So if you could pick the organizations that are running more like a business, even though they don't have that outside pressure to do so, your money's probably going to go a longer way towards doing what it is you want it to do. So, quote, the pandemic has created unique challenges for tax-exempt organizations, and we want to make sure people don't overlook this special tax deductions that's available this year, end quote, said Sanita La, I probably mispronounced that, I apologize, IRS Commissioner of Tax Exempt and Government Entities Division. Quote, donations to qualifying charities can reduce people's tax bill when they file in 2022, end quote. Leaders from the National Council of Nonprofit and Independent Sector, two prominent organizations representing the nation's charitable groups, highlighted that the special tax provision can provide additional assistance to organizations hit hard by the pandemic. Some groups have seen reduced charitable donations and others have seen increased demand for their services during this unprecedented period. Quote, at a time when nonprofits continue to see immense demand for services, are facing significant challenges hiring and retaining staff to deliver those services, every donation counts, end quote, said David L. Thompson, Vice President of Public Policy at National Council of Nonprofits. Quote, we're thankful that the universal or non-itemizer deduction is available through the end of the year to encourage every taxpayer give a little bit more to the missions they care about, end quote. Quote, over the past 2 years, charities have helped America confront generational health, economic, and social crisis. They have answered the call to serve their communities despite facing lost revenue, disrupted operations, and dramatically increased need, end quote, said Daniel J. Cardinali, President and CEO of Independent Sector. Quote, Congress has sent a powerful message that everyone, not just those who itemize on their taxes, has a role to play in helping meet this moment, and we know people in America will respond in kind. We hope charitable contributions and deductions will increase increase in the coming years, end quote. Included in the Coronavirus Aid, Relief, and Economic Securities CARES Act, enacted in March 2020, a more limited version of this temporary tax benefit originally only applied to tax year 2020. So this was basically put in place when, a lot of the changes were made to the tax code. This was like immediately one of those kind of things where they're like, maybe we should put this charitable deduction elsewhere, but obviously to get the laws passed and so on, they make it a temporary thing. If it's a temporary deduction like charitable deductions, you would think that they put it in place as a temporary type of deduction and that it would never go away after that point in time because they would argue that they're going to keep the deduction and it would never go away. That's a common kind of thing that will happen with most deductions that are proposed as temporary, and then they kind of plan on just keeping it on the books. So the Taxpayer Certainty and Disaster Tax Relief Act of 2020, enacted last December, generally extended it through the end of 2021. So it's still going through 2021. Now, obviously, the next question is going to be, well, what's going to happen to the tax code? Are they going to try to make the itemized deductions more relevant again, or are they going to keep the new kind of setup where it is a little bit more simplified in that the standard deduction is going to be more applicable to more people, and they've limited the impact of the itemized deductions, and then based on that, you would think that they might extend or not extend things like this charitable deduction that's seeping out from the itemized into other areas of the tax return. So nearly 9 in 10 taxpayers now take the standard deduction and could potentially qualify. Under this provision, tax year 2021 individual tax filers, including married individuals filing separate returns, can claim a deduction of up to $300 for cash contributions made to qualifying charities during 2021. The maximum deduction is increased to $600 for married individuals filing joint returns. Cash contributions include those made by check, credit card, or debit card, as well as amounts incurred by an individual or unreimbursed out-of-pocket expenses in connection with their volunteer services to a qualifying charitable organization. Cash contributions don't include the value of volunteer services, securities, household items, or other property. So when you're looking, so it's a little bit more restrictive when you're talking about the deduction here. There might be different rules, of course, if you're talking about the deduction, which would still be available if you were itemizing, if you have the ability to itemize. So there's going to be different rules between the two of those. If you're itemizing, then you'll have different rules for the charitable deduction than if you're taking the charitable deduction outside of the itemized area and doing the standard deduction. The IRS reminds taxpayers that to receive a deduction, they must donate to a qualified charity. To check the status of a charity, they can use the IRS tax-exempt organization search tool. There's a link to that here. Cash contributions to most charitable organizations qualify for a deduction, but contributions made either to supporting organizations or to establish or maintain a donor advisory fund do not. So in other words, obviously, if you give money to an organization and you still have control over it, basically as an advisor, you didn't really give the money away in that case, so you shouldn't get a deduction for it. So contributions carried forward from prior years did not qualify, nor do contributions to most private foundations and most cash contributions to charitable remainder trusts. In general, a donor advised fund is a fund or account maintained by a charity in which a donor can, because of their donor status, advise the fund on how to distribute or invest amounts contributed by the donor and held in the fund. So again, if you're like, it's not really my money, I put it into this fund here, but I tell everybody what to do with the money, that you kind of have control. So a supporting organization is a charity that carries out its exempt purposes by supporting other exempt organizations, usually other public charities. So the IRS encourages all donors to be wary of scams masked as charitable solicitations. Criminals create fake charities to take advantage of the public's generosity. Fake charities once again made the IRS's dirty dozen. There's a link to that here. List of tax scams for 2021. So obviously the tax incentives of a charitable organization and so on can lead people to put together the fake charities. And there's a lot of different ways that the fake charity can kind of be used in an abusive way. So you do want to make sure that you're getting a qualified charity that's doing what it says it's going to do. And if it is doing it efficiently, your money's probably going further than it would going elsewhere, including to the government. So in October, the IRS also joined international organizations. There's a link to that here, and other regulators in highlighting the fight against charity fraud. Keep good records. Special record-keeping rules apply to any taxpayer claiming a charitable contribution deduction. Usually this includes obtaining an acknowledgement letter from the charity before filing a tax return and retaining a canceled check or credit card receipt for contributions of cash. So if you make your charitable deduction, you usually don't want to give cash. It might be the convenient thing to do sometimes, but you'd like to have an audit trail of it. And if you can get the letter from the charity as well, given the acknowledgement, then those are the things you're looking for. You obviously want the audit trail when you're looking at deductions. So that means cash is not generally good. You want the audit trail, credit card, check, then documentation, receipt. For details on the record-keeping rules for substantiated gifts to charity, see publication 526 Charitable Contributions, available on irs.gov. There's a link to that here. There'll be a link to this in the description.